Good morning, and today we're looking at the review for exam number 3. So this exam covers chapters 7, 8, and 9. And remember, to get to the practice set, you need to, in Cengage See Now, you need to click on the link that says assignments I can practice now instead of the default, which is assignments I can take now, because this is not graded, so it does not show up there. At the request of a student who's here live with us at the review session, we're going to start with the exercises related to Chapter 9 and specifically for depreciation. We have, as you can see, 12 exercises in this practice set, and half of them are from Chapter 9. And these might be the more challenging of the exercises. So we'll start with these. We do have just 1 hour for this session built in. So we'll start with the Chapter 9 and then go back to the beginning and use the time that we have. So I'm starting with exercise 7, and that is, you can see from Chapter 9, and this is about straight line depreciation. I would also remind you that in the folder for Chapter 9, if I were to go there, I have this already up, but in Brightspace, in the reference materials area, if we go to the Chapter 9, a little slow, if we go to the Chapter 9 folder, you can see that page that has the terms as well as the formulas related to depreciation calculations. So I would remind you of that. Maybe you want to print that out or copy those down, or have them available at any rate when you go to take the exam this weekend. So we'll start with straight line depreciation, and the fact that it is straight line means that it is the same every full year of depreciation. The first thing we have to calculate is the depreciable cost. And this is the value of the asset that we're going to use up or record as expense over its estimated useful life. So the calculation for depreciable cost is the original or historical moment. So the calculation for depreciable cost is historical cost minus the residual value. Again, this is the value that we are going to use up or record as expense. And we're looking at the practice set. We're starting with the Chapter 9 exercises, if you just joined us. So for this exercise, then, the depreciable cost would be the 1.8 million that we paid for the asset minus the 200,000 that we're not going to use up. That's how much we think we'll be able to sell or trade in this asset at the end of its useful life. And so the answer to part A then is the depreciable cost, the part we are going to use up or record as expense, is $1.6 million. So that depreciable cost is the amount we will record as depreciation if we use this asset for the full 20 years that we think we're going to use it. And that number, the 1.6 million, is the expense that we would report regardless of which of the 3 methods we use, whether we use straight line, units of activity, or double declining balance. We're going to record a total of $1.6 million in expense. The difference among the 3 methods, the difference is not how much we record in total, but how we split that up, how we divide it up over the useful life of the asset. And so for straight line, we take that depreciable cost. So to calculate the depreciation rate, which is for letter B, we take the depreciable cost and we divide it by the estimated useful life. And so we're going to take that $1.6 million and divide it evenly over the 20 years. And so hang on one second. Let me just close my writing tool. And so what we are recording then, so they want this as a percentage, what we are recording is 1/20th or 5% of that cost each year. So 5%, and as I jumped ahead in my calculation there, the annual straight line depreciation then would be 5% or 1/20th of that 1.6 million or $80,000. So as I was saying, when I first started the recording, if you are here live, if you have any questions, you're welcome to unmute and ask your question, or you can put it in the chat, or however you can get your question answered. And if you don't have any questions, if you don't say anything or type anything in the chat, I will assume that you're good. And to maximize the use of the time that we have this morning, I will just keep going with the next exercises. So that's straight line depreciation. It's called straight line because we report exactly the same amount every year, as long as it's a full year. And we spread that full depreciable cost evenly or in a straight line across the estimated useful life. The next exercise deals with units of activity, and the idea of the units of activity depreciation, again, as I said in the last exercise, we would still be reporting exactly the same amount of depreciation as we would under any of the methods, but it's a question of how we split that up. And so when we use the units of activity, instead of using the passage of time, instead of recording the same amount per month or per year, we're recording the same amount per some other estimate of the useful life. So in this particular case, we're talking about a truck that we bought, and we expected to be able to drive that truck 200,000 miles. So rather than reporting every year, rather than saying we're going to use it for 10 years, how much is it going to be costing us each year, we're spreading it out based on the actual usage. And so the rationale for a units of activity depreciation is in years that we use it more, presumably it helps us to make more money or earn more revenues. And so we would record more expense in those heavy use years and less expense in the years that we don't use it very much. So the depreciable cost is calculated exactly the same way as it was in the previous exercise. We start with our historical cost of, in this case, $60,000. We subtract from that the residual value, and I can label that letter A. So for this truck, the original value of the truck, $60,000, minus the $2,000 we think it will be worth when we're done using it, we're going to use up or record as expense $58,000 worth of that truck. Rather than expressing the estimated useful life in time, in years or months, we express it based on the usefulness in miles. And so the calculation for the depreciation rate under units of activity is expressed per unit of use. Again, for this truck, we're measuring that in miles. And so we want to spread that $58,000 depreciable cost, $58,000 depreciable cost over the 200,000 miles. 58,000 divided by 200,000 miles gives us a rate of 29 cents per mile. And so just like under the straight line method, we could calculate up front, here's how much it's going to cost us per year, 5% of the depreciable cost, or $80,000 like we saw in the last exercise. Here, we can calculate up front before we even start using the truck. We're going to report 29 cents per mile in expense. What makes the units of activity method different is we don't know until the end of the period how much we actually used that asset. So unlike straight line, or double declining balance, where we know how much we're going to report each year or each period that we use it. For units of activity, we have to, in this case, actually go check the odometer on December 31st and see how many miles did we use it this year. There's no way we can know that in advance. We can budget for it. We can project, I think we'll use it for 10,000 miles this year or 14,000 or whatever, but we can't know until we've actually driven the miles. We have to look at exactly how many miles did we drive. Was it 14,000 or was it 14,100? Was it 13,099? For part C then, it asks us to calculate the depreciation for the year in which we drove 15,000 miles. And so for that last calculation, part C, we'll take the 29 cents per mile and multiply by the actual usage. And that's the part, as I said, we can't know in advance how much we're going to use it. We can project, but we have to then verify that by checking the odometer or however else we're measuring the usefulness of this asset. And so 29 cents per mile times 15,000 miles. In the year that we drive it 15,000 miles, we would record $4,350 in depreciation expense. Again, if you have any questions, please just let me know. Otherwise, if you don't let me know you have a question, I'll assume everybody's good and we'll keep going. So the next exercise is double declining balance depreciation. And based on those formulas that are in the Chapter 9 reference materials in Brightspace, you'll notice that unlike what we just did in straight line and units of activity, the formula for double declining balance doesn't start with the depreciable cost. It actually starts with the full historical cost because it uses carrying value in place of depreciable cost in the formula. So the double declining balance rate, and we didn't really use that term rate when we talked about this in class, but the double declining balance rate, just like the rate for straight line was calculated as a percent of the depreciable cost, the double declining balance rate is going to be the percent of the carrying value that we report each year as depreciation. And the calculation is very similar to what we did for the straight line method, where we took 1 divided by the useful life. But because this is double declining balance, we're going to take 2 and divide by the useful life. And so for this exercise, it tells us that the estimated useful life of this asset is 40 years. So 2 divided by 40 is 5%. So again, to calculate the rate, it's 2 divided by the estimated useful life. And we're expressing it as a percent. So 2 divided by 40 is 5%. For the first year then, the calculation, again, as you see in Brightspace in the reference materials, the calculation starts with the carrying value rather than the depreciable cost. We don't subtract that residual value. We base the first year depreciation on the full amount, on the full original cost of that asset. And so 3,850,000 times 5%, the first year depreciation would be $192,500. Now the second year, and I know the exercise does not actually ask for it, but I just want to remind you, certainly on the exam, you could be asked for something beyond the first year calculation. So the second year calculation is that carrying value. So carrying value we know is the upfront or historical cost minus the accumulated depreciation. At this point, we've reported only 1 year of depreciation at 192.5, and we're going to report 5% of that remaining value as the depreciation for the second year. So 5% of that carrying value. In the second year, we would report $182,875 worth of depreciation. Still quite a bit, but less than the year before, because each year as we report new depreciation, the carrying value comes down. So for straight line and double declining balance, the company is able and would set up a depreciation schedule for those assets at the time they acquire them, because they already know they can calculate how much they're going to report as depreciation each one of the years that they plan to use that asset. We can't do that for the units of activity method. The only thing we can do is determine how much we're going to charge or record as expense for each unit of activity, each mile or each hour that asset is used. But for both of the other two methods, straight line and double declining balance, we would have a depreciation schedule the moment we buy that asset. We probably would have already done those calculations before we even make the decision to buy the asset, because that's part of the decision-making process. How much is this going to cost us in expense on our income statement? And the reason I said cost us like that is because the expense is not a cash expense. So no one's actually sending us a bill, but we're looking at how it affects our profitability. Depreciation doesn't affect cash flows at all. As we look at this building in this exercise that we have on the screen right now, the cost is $3,850,000. And we're paying that up front, or maybe taking out a mortgage for it or whatever, but that doesn't really, that doesn't change regardless of which method we choose for recording depreciation. So depreciation, again, is a non-cash expense. So I should get my green check marks. Maybe I can do that. Get my green check marks in there. Any questions about double declining balance? Okay. So let's move on then. And since we're in chapter 9, we will stick with these chapter 9 exercises. And then, as I said, we'll go back and start from chapter 7, assuming we have time within our hour here. So exercise 10 in this set is similar to one that we had done in class, that, you know, we calculate depreciation in good faith when we acquire the asset, but we know exactly how much we paid for that asset. But what we have to estimate is how much it's going to be worth at the end of its useful life, and how long are we going to use it. Those two things obviously are connected. The longer we use it, probably the less it's going to be worth when we're done. But those are estimates, and sometimes those estimates turn out not to be correct. And if they're really incorrect, if they're really off target in a material way, that is, that it would, having different information, having the correct information would potentially lead a decision maker to make a different decision, we would have to modify that or revise it partway through the useful life once we have that new information, to make sure that the information we're presenting on our financial statements is as accurate as possible, to make sure it's not misleading. So I don't mean it to sound like we've done something wrong, because we didn't intentionally mean to defraud anyone or give them faulty information, but the information we had up front, especially those estimates in particular, turned out not to be as accurate as we would have liked. So for this asset, we are asked to consider that it had an upfront or historical cost of $240,000. We expected that at the end of its useful life, at the end of 12 years, it would still be worth $18,600. And so at the beginning of the period that we're using this asset, we were going to divide that depreciable cost over 12 years. And so at the beginning of the useful life of this asset, we start recording $18,450 each year. And we go along like that for 10 years, recording $18,450 per year. It doesn't actually tell us, but we can assume, because it doesn't give us any different information, that that first year was a full year. And so at the end of 10 years, we have recorded 10 years at $18,450. So 10 years at $18,450, we've recorded a total accumulated depreciation of $184,500. So the book value at the end of those 10 years would be, whoops, you have to punch it into your calculator correctly. $55,500 left. $55,500 of that original value is left. That's the book or the carrying value. Now remember, at that time, we at the end of the 10th year, we had still expected to use it for 12 years. So we expected 2 more years of recording $18,450 a year. And at the end of that 2 more years, our book value would have been $18,600, exactly what we said at the front, at the beginning, that it would be worth. But letter C says, okay, but hang on. At the beginning of the next year, we look at this asset and we say, I know we thought we were only going to use it for 2 more years, but I'm looking at it and I think we can use it for 4 more years. And we'll just use up a little bit more of that residual value. And so the residual value, rather than being 18,600, would be down to just 4,800. And so now it's kind of like starting from scratch. We're going to do a brand new calculation. There's nothing that says we can't use it for 14 years, even though originally we thought we'd use it for 12. There's nothing that says you can't use it for 2 extra years and revise your depreciation as we are doing here. And so, as I said, it's really like doing a brand new calculation where we're looking at an asset that has right now a value of $55,500, and we're going to use it for 4 more years. At the end of that 4 more years, we expect it to be worth only $4,800. So how much more of that value are we going to use up? That, what I have there in parentheses, is our new depreciable cost, or our remaining depreciable cost. And we're going to take that amount and divide it over the 4 years that we expect to still use it. So the remaining depreciable cost is $50,700, and we're going to divide that over 4 years. And so at this point, we're going to change our depreciation for the remaining 4 years to $12,675. It's only about 2/3 of the original depreciation. Why did it go down so much? Because we're getting 2 extra years of use out of it for about $14,000 more dollars worth of that residual value that we're using up. And so rather than costing us $18,000 a year, those extra 2 years are only costing us about $7,000 per year. And so we're going to modify or adjust that remaining depreciation so that, again, our goal is when we finish using it, now 4 more years from now, the book value or carrying value at that point will be the $4,800 that we estimated. Now, at the end of the 4 years, is it really going to be worth $4,800? Maybe. Might be worth more than that, might be worth less than that, might not have any value at all. And that's what we're going to see in the next exercise. Okay, so what do we do with that case when we actually dispose of or sell the asset at the end of its useful life? whether that's when we thought we would stop using it or not. How do we record that? So any questions about revising depreciation? So again, the whole idea there is we do the best we can, but we know that these calculations include two different estimates, and it's highly likely that both of those aren't exactly correct. And so we do the best we can to try to provide the information that's useful and as accurate as possible. But we can't wait until we're done using the asset and then go back and record the depreciation for all 12 or 14 or 20 or whatever years. We have to build in that estimate because we have the timely reporting of our financial information actually is more important than the 100% accuracy. We do the best we can. And so moving on then to our next exercise, if there aren't any questions. Now we're at the end of the asset's useful life, and we need to report that we are selling or disposing of that asset. Equipment was acquired at the beginning of the year at a cost of $800,000. The equipment was depreciated using the double declining balance method based on an estimated useful life of 10 years and an estimated residual value of $60,000. So our first question is, what was the depreciation for the first year? So we know that double declining balance is based on the carrying value, which at the time in the first year before we report any depreciation, that carrying value is $800,000. The depreciation rate for double declining balance is 2 divided by the estimated useful life. And so in that first year, we would report depreciation of $800,000 divided by 5, $160,000. So the question does not ask us this, but we'll need it for the next part. So I'm just going to put another note over here. So at the end of the first year, the carrying value is the original or historical cost of $800,000 minus the depreciation we reported in that first year. And so the carrying value at the end of year 1 would be $640,000. Remember that carrying value isn't intended to be the fair market value. It doesn't really reflect how much do we think this is worth. We expected to use this asset for 10 years. So we weren't trying to make the value at the end of year 1, 2, 3, 4, 5, and so on match the actual amount that it's worth if we tried to sell it at that point. But for some reason, they do sell the equipment at the end of the second year. So it's the end of the second year. So we're going to have to calculate one more year of depreciation here. So the carrying value at the end of year 1 is $640,000. So let's calculate our year 2 depreciation. Again, we know for double declining balance, the calculation is carrying value times 2 divided by the estimated useful life. So the year 2 depreciation would be $128,000. And then I'll calculate our year 2 carrying value, or book value is another term for that. So we've subtracted another $128,000 from last year's carrying value. In year 2, end of year 2, the carrying value is down to $512,000. So it started at $800. At the end of year 1, it was $640. At the end of year 2, it's down to $512,000. Everybody okay with those? Let me know if you're not sure where those numbers are coming from. And so as I said, that $512,000 carrying value at the end of year 2 isn't meant to represent the fair market value. We are depreciating this asset very quickly. That's what happens with double declining balance. It's an accelerated method. We front load that depreciation. We report more up front and less later on in the life of the asset. And so given what's said here in letter B, assume the equipment was sold at the end of the second year for $650,000. Well, according to our books, it's only worth $512,000. So we know that we're going to be reporting a gain on the sale of that equipment. We sold it for more than our book said it was worth. The question we need for, or the other part we need for this exercise is how much was that gain? So to calculate that, we need to compare the selling price to the book value. So the selling price was $650,000, the book value was $512,000, and the difference between them then is $138,000, and that again will be a gain. That gain shows up on our income statement as a just similar to the way a revenue shows up. It increases our net income, it increases our operating income. So what are we really saying there? What we're saying is last year, the first 2 years, the combination of those 2 years, let me show you this here. The combination of those 2 years, we reported 160,000. Let me change the color of that so it can show up. 160,000 in the first year, 128,000 in expense the second year. That's a total of $288,000 in depreciation we reported, but the asset didn't really lose $288,000 worth of value. It went from 800 down to 650. It really only lost, in terms of market value, $150,000. But we recorded $288,000 in total depreciation over those 2 years. Remember, the depreciation then reduces our operating income, reduces our net income. It actually saves us money on taxes because we reported more expense, right? So our income is lower. It didn't affect our cash flows. We still paid $800,000 for this piece of equipment, but it saved us money on taxes by front loading that depreciation. At the end of the second year, when we sell that piece of equipment and report this gain, that's going to increase our income. We have to make up for the fact that we've reported more depreciation over the first 2 years than we really experienced in terms of actual erosion of the market value of this equipment. Again, it's not that we did anything wrong. We didn't do anything unethical or immoral. The only part that would be unethical is if we said we plan to use it for 10 years, knowing the whole time we only actually plan to use it for 2 years. So that's the only potential concern here is, did we really think we were going to use it for 10 years and then something changed? Because if we only meant to use it for 2 years, we should have only been reporting depreciation based on those 2 years. But that gain makes up for it. So at the end of the second year, our income is going to go up to reflect our actual loss of market value. To finish up this exercise then, journalize the entry on December 31st to record the sale. So we know that at the time we sold it, we received cash. So one account that's going to be affected is cash. How much cash did we receive? We sold it for $650,000. So we need to show that we received that $650,000. Now, we don't have the equipment anymore. The equipment was recorded at its original or historical cost, and we need to get that off our books because we don't have it anymore. We just sold it. We also need to get off our books the accumulated depreciation for that equipment, and that's going to be the combination of the 160 from the first year plus the 128 for the second year, a total of $288,000 in depreciation or accumulated depreciation that we need to get off our books. If we look at this, we know we can't be done because the debits and the credits aren't equal. They're out of balance. They're out of balance by $138,000. And that $138,000, as we said in Part B, is the gain that we realized that when we sold the equipment. It's making up for the fact that we reported too much depreciation in the first 2 years. So now we're kind of canceling part of that out. And so that's how we report the sale of a long-term asset. We have to compare how much we realized from the sale to its book value. It could result in a gain or a loss. So let me get my green check marks in there. Any questions on that exercise on how we report or record the sale of a long-term asset at the end of its estimated useful life or at any other point? All right, well, let's move on then to our final exercise for Chapter 9. And this exercise is related to depletion. So this is for a natural resource. I said in class that this depletion calculation is really the same concept as using a units of activity or units of production method for recording depreciation. Depletion is the specific term that we use for natural resources. And so our first question is to determine the depletion rate. Again, this calculation looks just the same as what we do for the units of activity. We take the cost of that asset that we're going to use up. And so for this case, there's no residual value. We didn't buy the property. We only acquired the mineral rights. And so that full $494 million is to acquire the rights to harvest these minerals. And so before we even start doing the harvest, before we even make the purchase, we're going to calculate how much it's going to cost us in depletion expense per unit of that natural resource. In this case, it's per ton. So 494 million divided by 475 million tons gives us a depletion rate of $1.04 per ton. It then tells us that during the current year, 31,500,000 tons were mined and sold. And again, I talked about in class that it's important that we know that it was mined and sold in the current year. If we didn't sell everything that we mined, then that would leave us with some inventory available for sale on our balance sheet. The fact that they mined and sold all of this in that same year, that their inventory level didn't change, means that we're going to report for depletion expense $1.04 per ton times the 31.5 million tons. And so the dollar amount that we're going to report as depletion expense would be $32,760,000. And the last part of this exercise asks us to journalize. So what's that going to look like? Just like with depreciation expense, we're going to report depletion expense and then accumulated depletion, just like we do with depreciation expense and accumulated depreciation. We don't have an exercise in this practice set related to intangible assets, but just as a reminder, for intangible assets, we call it amortization, and we do not have an account typically called accumulated amortization. We make those entries directly to the asset itself. So the exercise we did in class, we were looking at the example of a patent. And so when our patent value goes down, we don't record accumulated amortization, we just reduce the value of the remaining patent on our books. Okay, so that is all of the review from Chapter 9. Again, if you have any questions on that, please go ahead and ask. And we have about 15 minutes left in our review session. For those of you who are here, do you have a preference of whether we look at chapter 7 or chapter 8? Because we're not going to be able to get through all of it. For people who might be watching this on the recorded video, anything that we don't get to, if you have questions on it, remember you might have the show me how button on a lot of these. You also have the check my work, and you certainly can email me and ask for help or set up a separate appointment. Someone just unmuted. Do you have a thought about which one we do next?
Yeah, it was me. Could we do chapter 7, please?
Yeah, nope, happy to do that. So let's go back to chapter 7. And chapter 7, remember, was the cash, not cash, cash and internal controls chapter, sorry. And so a lot of what we talked about in chapter 7 wasn't what I think of as doing accounting. And so we only have a couple exercises related to chapter 7. Specifically, what we talked about was managing our cash, that is verifying that the cash that we think we have is what we actually have, as well as managing petty cash. And so this first exercise is related to bank reconciliations. All companies, and I would argue every person, should also be doing a bank reconciliation on a regular basis, that is verifying that what the bank says you have matches what you believe you have. And so this exercise doesn't give us the format of a bank reconciliation like what we did in class, but we can kind of make our own over here in an informal way. So we know that we're going to be starting with the bank balance, which we're told is $25,750, and we're comparing that to our balance, which we're told is $19,140. And our job with the bank reconciliation is to identify the differences. So what does the bank know that we don't know? What do we know that the bank doesn't know? Our first question is, what is the adjusted balance on the bank reconciliation? And so the end result here is that we have an adjusted bank balance. Hopefully I'm giving myself enough room here. And we have an adjusted company balance. And if we've done our job to have a successful bank reconciliation, those two numbers that I just listed, the adjusted bank and adjusted company balance, need to be the same thing. And so letter A, what is the adjusted balance? It's going to be either or both of those numbers. They have to be the same. So let's take into account what is it that we know and what is it that the bank knows, and put those adjustments in here. So first, the bank had some service charges. Just going to abbreviate. And so the bank already subtracted that from our records, but we haven't subtracted from their records, excuse me, but we haven't subtracted it from our records yet. So that's going to be one adjustment. How do we know about that? It's on the bank statement. It tells us we had service charges for $45 for, I don't know what they did for us, but something. Deposit in transit. So we've already reported this deposit in our records. The bank, because of a timing issue, doesn't have it on our statement. And so once the bank catches up with us, that additional $2,300 will be in our books. Well, the bank also collected so the bank also collected for us a note, and we talked just this week about notes payable, and in chapter 8 that's on this exam, we talked about notes receivable. And so we didn't know, we knew this note existed, but we didn't know that the bank had collected it, that our customer had paid the bank and they put it in our account. And then finally, we've written some checks that whoever we wrote them to, the payee, hasn't cashed them yet. And so the bank still has that amount, $37.55 in our account, we already know we spent it. And so let's do these calculations and make sure that we have a successfully completed reconciliation here. We start with the bank balance and add the deposit and subtract the outstanding checks. And I got 24,295. But let's do that same calculation down here in the company part of our books. And luckily, we got the same number down there. I didn't put a dollar sign. Apparently I missed there. So luckily those two numbers do balance. If they didn't, we'd have to keep going. What else happened here that we don't know about? But the adjusted balance of 24,295 is what we got for both the bank and the company. Again, they need to match, and that's the amount that should show up on our balance sheet at the end of this period. Part B then asks us to, if there are any entries we need to make to our records, to put together what those journal entries would look like. And as we discussed in class, anything that we said was an adjustment to our books, so we have two things here that we had as adjustments. What we're saying on the bank reconciliation is those two items need to appear in our records. And so part B is, how do we get them there? What does the entry look like? So the first one is that service charge. So we need to remove the $45 from our cash because the bank already took it out of our account. And what are we going to call that? Well, just like we did with the exercise in class, they probably don't have enough bank charges that it needs its own separate account. That's a pretty small dollar amount compared to the rest of what we're looking at. And so we'll probably just code it as miscellaneous. And then the other part is that note. So we had a note receivable. We had a note receivable for $5,000, and our customer paid us the $5,000 plus $200 in interest. Well, again, it's a reconciling item here because we haven't put that into our records yet. So we need to show that we have the $5,200 in cash. Then between these two entries, our cash balance has gone from $19,140 that it said when we started this process to $24,295 because we took out the 45 and put in the 5,200. And so that part so far has fixed or corrected our cash balance. Because our customer paid us the $5,000 that were borrowed on that note, we need to take that note off our books, but we also get to report the interest income or interest revenue associated with that. And so that $200 in interest is going to show up on our income statement. So again, this exercise didn't give us the format for doing a bank reconciliation, but if you see something similar to this on your test, I would encourage you to use, a notebook or something to do these calculations, to actually write it down. Will be helpful for you in the long run. So if there aren't any questions on that, we'll go on to the second exercise for chapter 7. Which is dealing with petty cash. And so we talked about petty cash, or another word for petty cash is an imprest fund. You might see it called that. I can't recall if I actually used that term in class, but an imprest fund is the same. It means the same thing as a petty cash fund. It's just a different term for it. And so at the time that the company establishes the petty cash fund, they move that dollar amount out of the cash account into a petty cash account. What would happen on the, on the real side is there'd be a check for $500 to establish this petty cash fund. That check would be cashed into small bills and change, have it in a locked box that only the petty cash custodian has access to it. ideally. And then we have this $500 on hand to pay small expenses, to reimburse people for out-of-pocket expenses and things like that. Anytime there is a payment out of that petty cash fund, then a receipt should be issued. It should be signed by both parties, and you should have documentation of why, if you're the petty cash custodian, why you paid out that amount. And so that's what we have in Part B here. The amount of cash in the petty cash fund is now down to $85, and they need to replenish it. And so how much cash is missing? How much cash is missing out of that account or that box? It should have $500 in there. It's down to $815. So we need to put in another, don't need the decimals, another $415 to get us up to the full amount that should be in that box, the full restored petty cash fund. So what did we spend that $415 on? Well, we bought store supplies for $360. So I'm going to record that, $360 for store supplies. We also had some miscellaneous selling expense of $40, and I have no idea what that might include, maybe some postage, shipping, and whatever. And so those two things together account for $400. In other words, there's $15 that's out of the box that we're not really sure what happened to it, because we don't have a receipt, we don't have any kind of documentation. It tells us to record any missing funds in the cash short or over account. And so that's what we're going to put there, whatever amount we need to balance this transaction so that our debits and credits are equal. Whoops, that shouldn't say petty cash. I must have accidentally changed that. Sorry, it should say store supplies. I thought that's what I had clicked on. So this is how we would do the entry. But the other question I have is, that $15 missing seems like a kind of a big deal. And so we'd have to make a determination. What do we do about that? We know how to record it, but is this significant enough that we need to maybe at least have a conversation with the petty cash custodian about, you need to do a better job of keeping track. $15 shouldn't be missing on a monthly basis, or however often this is. And beyond that, we might need to consider some additional controls to protect it if we think that amount is material. Is $15 a big deal? It's only a big deal if we think it's generally we use more than 5% of the total as being material. But the fact that this is petty cash already indicates this is a small amount in the grand scheme of things for our company. And so if that $15 is not a material amount, that is, it's not big enough to matter, the only reason we would be concerned then is that we think someone might be stealing from that fund. So anytime there's a risk of fraud or embezzlement, regardless of how big or small, that's a concern for us. So we have just a couple minutes left in our assigned time for this review session. With those couple minutes, let me just take a look at what we have, and you guys who are here live, if there are any of these exercises that you really think would be more beneficial, let me know. So we have all of the Chapter 8 exercises are related to the allowance method. There are exercises using the balance sheet approach. There are exercises using the income statement approach. There are exercises for writing off a journal entry, writing off an uncollectible account. And then finally, the last one is for notes receivable. So for notes receivable, remember that you need to use the simple interest formula that we have now used a couple different times. I equals PRT. Make sure that you are, if you don't know how many days there are in a month to calculate the due date, make sure you're looking that up. Look at a calendar on your phone so that you get that date right. The maturity value of the note is the face value plus the interest, unless the note is discounted. We didn't really talk about that until chapter 10 yesterday, so you won't see that on your exam. For the other calculations for the receivables, make sure that you are, keep in mind for the AR aging approach like we have here, we have to first figure out how much we want to have in that allowance account, then look at what's already in there and determine how much we need to record as an entry to get from where we are to where we want to be. If you're using the net sales approach, then you don't even look at that allowance amount to figure out the entry. So here, bad debt expense is 1/4 of 1% of sales. So we would just take that 1/4 of 1%, multiply by the sales to determine how much we need to put into that uncollectible accounts allowance. Then we can find the ending balance for the allowance by taking what we already had in there and comparing it to the journal entry. So we are at the end of our time. Anyone who's here, any questions, anything else you really want to talk about? If not, as I said, as you're working through these, feel free to use, you should use as needed the show me how button, check my work button. If you're really stuck on something, absolutely, you should reach out to me by email or schedule an appointment with me in the next couple of days so you can get those questions answered before you try to take the exam this weekend. All right, well, thank you for being here. I'm going to stop the recording